Hey guys, it's James back for another comparison video, Qyld versus SCHD. I know these are very two different type of funds. This is a covered call ETF, mainly for income, and this is a dividend equity ETF, mainly for a small little bit of income as well as some very decent growth, having some very solid dividend funds inside this ETF. The SCHD is mainly for portfolios that I would think that people would want to grow very consistently and be able to hedge against bear markets, where Qyld is probably more for those that are looking for a high amount of income. They have a large portfolio, probably in the 6 or 7 figures, and they're just looking purely for income, or they would hold a little bit of this for income. Nonetheless, we will compare these two funds to see what we would have over the course of the next 10 years. This is Qyld's website page. It is Global X's NASDAQ 100 covered call ETF. The reasons to consider Qyld: it has a high income potential. It has monthly distributions or monthly dividend yields. They claim they are very efficient with their options execution. A few things I would like to note from their key information. The fund inception date was about 8 years and 3 months ago. The total expense ratio, we will use this. And the 12-month trailing yield, we will use this number here, 13.82%. The fund objective is to provide investment results that correspond generally to the price and yield performance of the CBOE NASDAQ 100 Buy Right Index. Over on SCHD's website page, their expense ratio is 0.06%. The fund objective is to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Dividend 100 Index. A few of the highlights: it's a straightforward, low-cost fund offering potential tax efficiency, where Qyld is taxed as normal income as far as I know. And another highlight of SCHD, the fund can serve as part of the core or complement in a diversified portfolio, tracks an index focused on the quality and sustainability of dividends, invests in stocks selected for fundamental strength relative to their peers based on financial ratios. A few key points I'd like you to pull from the fund profile or key characteristics. The fund inception date was October 2011, so I believe that's about 10.5 years ago. Again, expense ratio is 0.06%. We'll use that. And coming down to the 12-month trailing yield distribution, 2.92%. Just taking a look at the overlap of Qyld versus SCHD, there's 8 overlapping holdings. 7.8% of Qyld is in SCHD, and 8% of SCHD is in Qyld, for a total weighted overlap of 9%. Coming over to Qyld's market price data, we look at the entire history of the fund, and it starts around $25. And what we want to do is determine a CAGR number over the history of the fund. If we drew a straight line from the starting value to the ending value, what would that look like as a cumulative annual growth rate? So 25 is the starting value, and the fund has been around for 8 years and 3 months, so those are the two figures we need. Over on Schwab's Seeking Alpha page, here's what their data would look like. They started at $25. That was their market price in October of 2011. 10.5 years later, it's pretty much been all uphill, and in January, their slide was not as drastic as Qyld. So $25 is their market price, and 10.5 years to be able to increase to $79.46. Before we go over to Portfolio Visualizer and compare the history of these funds next to each other, we're going to calculate the CAGR number over on another tab on my spreadsheet. The starting value was $25 for Qyld in a time period of 8 years and 3 months, so 0.25, 1 quarter of the year gone already, with an ending value of the current price, $20.87, for cumulative annual growth rate over this time period of a negative 2.16%. Similar for SCHD, gives us a cumulative annual growth rate of 11.64% over this time period. Let's check out the history of these two funds. So we're with a $10,000 initial investment, and if we reinvested dividends, we'll take a look at what it looked like without reinvesting dividends. Qyld versus SCHD. And SCHD in the red would outperform Qyld with dividends reinvested. With dividends reinvested, you have a 7.6 CAGR over this time period, and with SCHD, you would have a 12.85% CAGR with dividends reinvested. Let's take a look at what it would look like without dividends reinvested. And with this negative CAGR without dividends reinvested for Qyld in the blue, Qyld would lose value over the course of this time period from 10,000 down to 7,800, where SCHD without dividends reinvested, pulling out the dividends, your 10,000 would go to 21,000 for a 9.5% CAGR number. Coming down to what the income would look like as you would pull your dividends out of Qyld in the blue, you can see you would have more income with Qyld, but your fund value would go down over time. And in the most recent year, with a $10,000 initial investment at the beginning of 2014, you would have $1,100 in Qyld income in the most recent full year and $600 in SCHD. Coming back over to the spreadsheet, Qyld's trailing 12-month yield was 13.8%. Their expense ratio is calculated into the graph at 0.6%. We're going to start with a $0 monthly edition with that negative 2% annual growth rate, starting with $10,000 with dividends reinvested. Over on SCHD's column, 2.85% dividend yield, 0.06% expense ratio. They pay a quarterly dividend. We're going to start with $0 monthly edition for an annual growth rate of 11.64 over the entire history of the fund, as we calculated from the 10.5-year history of SCHD. So we're going to reinvest dividends with $10,000 invested, comparing a very similar amount. SCHD would outperform Qyld with dividends reinvested. Let's say you wanted to pull dividends out. How would it perform? Well, that 11.6% growth rate would allow SCHD to continue to grow, but as you pull the dividends out over the course of 10 years, you can see SCHD would start to overtake Qyld in dividend payouts. So over the course of time, let's say we reinvested all of the dividends and we added $500 a month for Qyld and $500 a month for SCHD. That $500 a month deposit would be $127,000 in Qyld over 10 years and $166,000 in SCHD over 10 years. After 10 years, your Qyld fund will be paying you $15,000 a year, and SCHD would be paying you $4,000 a year. So with that same monthly addition, if you did not reinvest dividends, this is what you would be receiving. After 10 years, your $10,000 with $500 a month would get you $60,000 with Qyld in the blue, and your SCHD without dividends reinvested would get you $138,000. Here's what the income would look like over time. After the course of 10 years, your $60,000 in your fund would get you almost $8,000 a year, and your $138,000 with SCHD would be getting you $3,300 a year without dividends reinvested. And over here we have just a simple calculation pulling off of their dividend yield number. If you wanted to make $10 all the way up to $5,000 a month, this is how much you would need to hold in Qyld and SCHD. If you wanted $1,000 a month in dividends or $12,000 a year, you'd need $86,000 in Qyld and $421,000 in SCHD. If you wanted $100 all the way up to $100,000 a year, you would need $724,000 in Qyld for this annual dividend number and $3.5 million in SCHD for this annual dividend number. Head down into the comments and let me know what you thought of this comparison, and if you'd like me to compare two more funds, let me know. Again, this spreadsheet is available on Patreon if you want to play around with the numbers. And with that, thanks for watching.